everyone, and welcome, Paige. Everyone, this is Paige Ringkamp with USA Mortgage. So, Paige,
Yep.
why don't we start and just introduce yourself a little bit?
Yes. So as you just mentioned, my name's Paige. I'm a mortgage banker at USA Mortgage. We are loving the fact that rates have been low, but I think everyone has refined that wanted to. So they're starting to tick up a little bit. So we're kind of starting to catch our breath. So can't complain.
Good, good. Yeah, I know that it's been crazy for all of you guys. These
Yes.
historic low rates are just weird.
Right. Right.
Awesome. All right, well, I have a couple questions for you. So I'll start with the easy question. What types of loans are out there for buyers? I guess the more traditional loans for buyers.
Yeah, so there's quite a few out there. The traditional ones are going to be your conventional FHA, and then there's VA for veterans, and there's one called USDA, which is more for the rural areas. Conventional for first-time homebuyers, you can put as little as 3% down. FHA 3.5%, and then VA and USDA 0%.
Okay, those are great programs. So I think that some people think traditionally with conventional you have to have 20%, but you just said 3%, and that's less than the 3.5% for FHA.
Yes. So for conventional, if you're a first-time home buyer, no matter what you make, there's no income limit. You can put 3% down.
Wow, that's awesome. Okay, good to know for first-time buyers especially.
Yes, absolutely.
All right. So can you give me a couple scenarios? In what cases would you recommend different types of loans? You said that, there's FHA, there's conventional. So what's the biggest difference that you would recommend one over the other for a client?
So that's a good question. There's a lot of different factors that are going to play a role. How long are they going to be in the home? What are their intentions? Are they putting money into the home? Is it move-in ready? And in terms of qualifying, the two biggest things that we're going to look at are their credit scores and their debt to income ratios. So with conventional, if you have, this is just kind of a general rule of thumb, above a 700 score, and you think you'll be in the home for a while, then conventional would be the route to go. If you maybe have a little bit of a lower score, like lower 6s, or a little bit of a higher debt to income ratio, then FHA would probably be the route we would go. There's a ton of other things that play into it, but those are just the main ones that we look at.
Okay, cool. So there's not really a one size fits all approach for loans. It's really getting to know your clients and know what their situation is, and then making a recommendation based on that.
Yes, absolutely. So when clients call me and they want to have, these in-depth discussions about what they should be doing, I'll give them kind of an idea, but until I truly see their credit report, because it's not just the credit score, it's the makeup of the credit report. When was their last late payment? Even if they have a good credit score, if they have a late payment in the last 12 months, the system might respond to that differently than somebody else with the exact same score without any late payments. It looks at your credit usage, what type of income you have. So there's a variety of factors that play a role. Absolutely.
Okay. So do you have any super creative programs? I've heard of some interesting ones. So what are some of the more creative programs that you have?
Yeah. So, every company has similar programs, and some of us have programs that others don't, vice versa. So what a lot of people are using more so lately, just because of the market, is our renovation loan. So there's a FHA 203K and a conventional home style. And those are both renovation loans. They're very in-depth, tricky loans. I'm not here to tell you that they're the simple, easy fix.
Okay.
But people have found a home in the area that they really like, and it just needs some updating, or it needs an add-on or something like that. Those are loans that people are utilizing, where we essentially finance the renovation part into the loan.
Oh, that's interesting. Okay, so good to know that if you can't find exactly what you want, you may be able to borrow and make it what you want.
Correct. Yeah. Now I'm giving you the absolute skinny version.
Yeah.
A lot more that goes to it. The interest rates are a little bit higher, and the closing costs are higher as well. So it's definitely not for everyone.
Okay. Good to know that it's available though.
Yeah.
All right. How do monthly payments break down? What do those look like?
That's a good question. So in your monthly payment, there's a couple things. Assuming that you include your escrow account, which is your homeowner's insurance and your taxes. And I always tell people, your escrow account is kind of like a glorified savings account. Every month you make your monthly payment, your servicer is going to take a chunk out of that and put it in your escrow account. That escrow account builds and builds and builds. And then at the end of the year, when your tax bill comes due, that escrow account will pay that for you. And then whenever your homeowner's insurance bill comes due, that escrow account will pay that for you as well. So in that monthly payment, your annual homeowners insurance and taxes are divided into 12ths, and then that portion is included. So you've got your principal and interest, which is essentially your loan amount financed across the life of the term. And then your homeowners insurance, your taxes. And then if you don't have 20% down, you have that monthly, what we call PMI or mortgage insurance included. So those are all the things that are typically included in your monthly payment.
Okay. So does my monthly payment fluctuate from month to month, or will it be consistent all the way through?
Assuming you're in a fixed rate, it should not fluctuate month to month. Now, there are some things that change though, like for example, your taxes are reassessed every odd year. So if your taxes go up, then they're going to readjust how they divide that up across the life of, if your taxes go up, they're going to adjust your monthly payments so that you're not short at the end of the year. Same with homeowners insurance. So those things can change, but if you're in a fixed rate, then your principal and interest should not change.
Okay, cool. All right. So you've mentioned PMI, and I've also heard it called MIP. So what is that?
So it's really just if it's conventional or FHA, but mortgage insurance premium or private mortgage insurance, it's just a fee that you pay as a part of your monthly payment if you don't have 20% down or 20% equity. So I always explain to people, it's kind of like if you put yourself in the investor's shoes, and Megan, you and I are each buying $100,000 house. I only put 3,000 down, I put the 3% down, and you put 20,000, put the 20 grand down. If we are going through a tough time, who's going to have a harder time walking away from that property?
That makes sense.
You're going to have a harder time because you have more skin in the game.
Sure.
So I'm considered more of a risky borrower for that investor. So I'm going to pay insurance to them until I have 20% equity in the property. Make sense?
Okay. Yeah, absolutely.
Yeah. So it's essentially insurance for the investor.
Okay. Okay. So if people have questions, or if they would like to reach out to start a loan application, or if maybe they do need to refinance yet, what's the best way for them to get a hold of you?
Yeah, that's a great question. My email address is pringkamp@usa-mortgage.com. And that's probably the best way to get a hold of me, and then we'll go from there.
Okay, awesome. And I'll link your email address in the description below. So if anybody needs to grab that, they can reach down there.
Awesome. Thank you.
Okay. And I guess the last thing, is there anything else that you'd like to tell potential clients?
That is a good question. Well, you already covered that the myth of the 20% down is needed. And that is a myth. That's not true. The other thing that I would want people to know is to pay attention to your credit report. So Credit Karma is not, it's a great tool because it does show you what way your score is moving. You know, if it's improving on Credit Karma, it should be improving with us as well, and vice versa. So utilizing your credit card app or your bank app or Credit Karma, whatever it may be, to keep an eye on your credit is a good idea. However, when we pull it, it is typically a little bit lower, not always, than what's reporting on those apps. So always monitor your credit, and just know that's not your exact score, but as long as it's moving, you know, as long as it's improving, then you're doing the right things. The other thing that I think people should know is that it's really important to keep all your credit card balances 25% or less than the total limit. So, and that's not an overall picture like, oh, of all my credit cards, I have $20,000 usage, or I'm sorry, $20,000 allotted. So I need to make sure my total is 25% or less. It's not a big picture thing. Credit card needs to be 25% or less, and that will help increase your score as well.
Okay. Simple, easy tips for people to do. Nothing significantly life-changing, but could definitely make a big difference when it comes to this.
Yes, absolutely.
Awesome. Okay. Well, Paige, thanks so much for your time today. I appreciate it. And if anyone has questions, reach out to us.
Yes. Thanks, Meg. Thanks for having me.
Yeah.
See ya.